Hello, my CFA friends, and welcome to Economics. We're going to be starting with our first reading on the firm and market structure. So let's get started. Okay, so we're going to be talking about cost curves and shutdown decisions. And I would like to draw our curves. So we're going to have the cost on the vertical axis and quantities on the horizontal axis. And we're going to be thinking about different types of economics curves. So the first curve that we need to understand is the marginal cost curve. And marginal in economics simply means additional cost, right? Marginal cost is our additional cost. You can see here that initially it would start high. Then as we increase quantity, it would drop, and then it will begin increasing. And that has to do with diminishing returns. Now, we're going to have two more important curves to consider. So the first curve is your average variable cost, or AVC. And the second curve is going to be your ADC, average total cost. So the way we're going to think about this is as follows. Average variable cost, it is things like your cost of goods sold, right? So your variable costs are, going to go up during times when you sell more goods, and of course going to have to go down during times when you're selling less goods. Your ATC, on the other hand, is your average total cost, and that will have to do with fixed costs such as rents and perhaps salaries. Now, something interesting about the interrelationship of the marginal cost curve and the ADC and the AVC is that they will basically intersect at the minimum points of the two curves. All right, so the marginal cost curve will intersect the AVC at the AVC's minimum point, and it will intersect the ADC at the ADC's minimum point. And this, of course, will give us two price levels. So this first price level, let's call it P1, and let's call this price level here P0. Let's also say that this is maybe $15 and this is $25. And now we need to ask ourselves a question, right? So if we have a company and the company can charge perhaps $10 for a product, would that company operate? So basically, would I operate if the price that I can charge is somewhere in this area here? Okay, so I'm basically below P0. I am charging less than $15 for my product. My variable cost is $15. Now, if that's the case, of course, I will have to shut the business down in the short run. Okay, I need to basically shut the business down immediately because it is not profitable to operate at that level. So the minimum price that I am willing to charge for a product must be the minimum of the average variable cost. Now, suppose, however, my business was able to charge $17, so somewhere between P0 and P1. So in this case, I am able to meet my average variable cost, my cost of goods sold, but I'm not quite able to meet my average total cost. Okay, so in this case, should I operate in the short run? Again, I am buying my product, let's say, at $15 from the supplier, but I'm actually able to sell it at $17. Okay, well, that sounds like a good deal to me. I'm making $2, which is the contribution towards my fixed costs. Now, if in the long run I'm not able to cover all my costs, I'll still have to shut down. but in the short run, I can operate. So here the conclusion will be to operate in the short run, but if the situation persists, then we have to shut down in the long run. Okay, now what about P1? What about if I was able to charge my customer $25, which is the minimum of the average total cost curve? Well, in that case, of course, I will be breaking even because I will be covering not only my variable costs, but also my fixed costs. Okay, and this is a very, very special position in economics. And let's go to the Word document to define that. Okay, so when the price we can charge is equal to the average total cost, we are breaking even, right? We understand that. But this is referred to as normal profit in economics, okay? And if we can charge a price which is equal to the minimum of the ADC, this will be our most efficient cost structure. And spoiler alert here, this will be known as perfect competition. So if you can charge a price which is the minimum of the ADC, you're going to have a perfect competition. And now this, of course, begs also the question, how are we going to refer to a situation where we can charge more than ADC? So if we are able to charge a price above ADC, this is known as economic profit or abnormal profit. This situation is only sustainable in the short run unless we have high barriers to entry. And we will see this in some of our structures. In particular, we will see it in a monopoly, right? In a monopoly, we would have high barriers to entry, and therefore we will be able to have economic profit in the long run, okay? Now, going back here to this situation, when the price we charge is equal to the ADC, this is referred to normal profit or zero economic profit. So there is a little bit of lingo here to learn. Make sure you learn the lingo before you plow on. So once again, if I charge a price equal to $25, that is simply normal profit. I am breaking even. At that point, I would be willing to operate in the short as well as long run. And typically, this is going to be the equilibrium position in situations such as perfect competition and monopolistic competition. However, if you are able to charge even more, then you would be in a position of economic profit or abnormal profit. This is not going to be sustainable in the long run unless you have high barriers to entry. So this will not be a point of equilibrium in models such as perfect competition and monopolistic competition, which of course are coming up. Okay, let's have a look at a shutdown example. A company has revenues of 2.5 million, fixed costs of 1 million, and variable costs of 2 million. Should the company operate in the short and long run? Okay, so my revenues are 2.5 million. My variable costs are 2 million, and I'm subtracting my variable costs from my revenues to obtain my contribution, okay? And my contribution here is 0.5 million. So what I mean by contribution, I simply mean that I've covered now my variable costs, I've covered my cost of goods sold, and this is the money left over that I can put towards my fixed costs, towards my salaries, towards my rents. Okay, but what are my fixed costs in this business? My fixed costs are 1 million. and if I subtract 1 million from 0.5 million of a contribution, my P&L, my profit or loss, is actually negative 0.5 million. So I did actually make a loss here in this business. Now, what does that mean? What does that mean? That means that I can operate in the short run. I can operate in the short run because I have covered my variable cost and I have a positive contribution, but I have to shut the business down in the long run because my P&L is negative. Okay, the next topic we're going to look at is economies of scale. And again, let's begin by drawing a diagram. So I've got cost on the vertical and quantities on the horizontal. And now I'm going to have the long run ADC, or the long run average total cost curve, which is behaving in this particular manner. Now, first of all, I can see that there is some sort of optimal quantity, let's call it Q star, which minimizes the average total cost in the long run. But to the left of this optimal quantity, ADC is higher, and so is ADC higher to the right of the optimal quantity. Now, we have to know some lingo. In the left section of this curve, while ADC is declining, this is going to be known as economies of scale. And to the right, where ADC is increasing, this is going to be known as diseconomies of scale. So what might cause economies of scale? What might cause your costs to be declining? Well, first of all, take the example of a car manufacturer. If I build a big factory to just produce one car, right? If I have a very, very small quantity, big factory, but just produce one car, I'm not going to be very efficient. So my costs are going to be high for that one car. My total cost will be high. So what I want to do is I want to expand production. I want to have a large production of cars that will bring my costs down. So I want things like labor specialization. Let's say if I've got a building site, perhaps I want more than one builder, right? If I'm building a house, I don't want one person to be doing everything. I want one person to be laying bricks. Yet another one needs to be a roofer. Another one needs to be a plumber. Another one needs to be an electrician. So I'm trying to essentially specialize my labor so that we are as efficient as possible. Also, a larger business probably will be able to command discounts on raw materials and so on and so forth. However, with these economies of scale, we are going to see that average total costs are rising. Why would that happen? Well, businesses get very large, they get very red tape-ish, very bureaucratic, very inefficient. Perhaps we have too many workers, perhaps their functions, their jobs are overlapping. Perhaps our business has gotten so large that we are bidding up the prices of raw materials. And so ultimately, what we need to do is find that sweet spot where we are minimizing the average total cost curve. Okay, so we're going to start with our first market structure, which is that of the perfect competition. So key points here, we are going to be a price taker who is facing a perfectly elastic demand curve. So I want to start you with that straight away, that concept. So a price taker is someone who cannot control the price. The price is given to them. So they are facing, therefore, a perfectly elastic demand curve, which means that the demand curve is a horizontal line where the price is fixed at any quantity, right? So this is our demand curve, but because it is flat, this is also our average revenue curve. And because it is flat, it is also our marginal revenue curve. So remember, average revenue is just simply the sales divided by the number of units sold. So that'll be just equal to the price. We're selling them at the same price. Marginal revenue will be just the additional revenue from selling an additional unit. That will also be given equal to the price because we are selling all units at the same price. Now, why are we price takers here? Well, think of perfect competition as selling a commodity. Okay, so we are selling a homogeneous, commoditized product. Think about a wheat seller, right? If I'm a wheat seller, I can't really differentiate or make my product look much more attractive than my competitor's product. It's a commodity, okay? So I will probably have to see what wheat is selling at currently in the marketplace, and I will be able to charge that price and nothing more, right? I'm a price taker. So we've got a lot of small independent firms, very important here. They cannot collude. There's no game theory here. Spoiler alert, this is going to happen in oligopoly, but not here. It's got a lot of small independent firms just competing with each other. There are no barriers to entry or exit. So that's very important as well, because we're not going to be able to have any economic profit in the long run. So then what else do we have here? We've got our marginal cost curve. And we also know, so this is very important, and I want to define it on Word, to maximize our profit in perfect competition, we must produce a quantity where marginal revenue is equal to marginal cost. There you go. Boom. So we are looking for this condition, MR equals MC. That is our profit maximization point. This is what we are trying to do, maximize our profit. So if you want to maximize your profit, what do? You produce where marginal revenue is exactly equal to marginal cost. So you can see in this case that this is our marginal revenue and not a marginal cost. So our Q star must be here. And this is the quantity that we will produce to maximize our profit. And our average total cost curve will look something like this. So there's your average total cost curve. And again, notice how the marginal cost slices through the ADC at its minimum point. Okay, so very, very important here. Firstly, we will notice that price is equal to ADC. Price is equal to ADC. But is it just equal to ADC or there's more to it? Well, price is actually equal to the minimum of the average total cost curve. So this is our most efficient structure. So not only do we get normal profit in perfect competition, but it is the most efficient normal profit because the price we are charging is actually the minimum of the average total cost curve. Okay, and I want you to think about this as we move to the next structure, which is monopolistic competition, where we're going to have to compare and contrast these two structures. Okay, now let's have a look at monopolistic competition. Again, we will have to draw the diagram, but here we are a price setter or a price searcher. That just means we can determine the price, we can set the price, and therefore we are facing a downward sloping demand curve. So let's have a look at that. Again, I've got the price on the vertical and quantity on the horizontal. This time I am facing a downward sloping demand curve. And because my demand curve is downward sloping, my marginal revenue curve is also downward sloping but steeper. Now, if you want to try and understand why the marginal revenue curve is steeper, you have to remember that with a downward sloping demand curve, if I wanted to sell an additional unit of my goods, I actually have to lower the selling price on all prior units as well. Let's have a look at our marginal cost curve. So our marginal cost curve will be upward sloping like that again. And we will find that the profit maximization point occurs where marginal revenue hits marginal cost. So there's your Q star again, and this is the price that I am able to charge. Let's call it price under monopolistic competition. We basically have an average total cost curve. The average total cost curve will look something like that. We have a minimum point where the marginal cost curve slices it. But again, as far as the price is concerned, the price is equal to the average total cost curve. So price is still equal to the average total cost curve. However, we are not at the minimum of the ADC, so the structure is not as efficient as perfect competition. It still only results in normal profit in the long run, but it is not as efficient as perfect competition. So what is the main difference here? The main difference is we've got a differentiated product. So instead of just all of us selling a commodity such as wheat or salt, now we are selling branded products. So think about clothing, apparel generally, or shoes, trainers. You can, buy Nike or Adidas or some other brand. So we have a differentiated product. Just like perfect competition, we have many small independent firms, right? So they're not colluding, they're not talking to each other. The main difference here is that they are price setters, so price searchers, not price takers, and their product is differentiated rather than commoditized. Now, again, we have low barriers to entry and exit. That means that in the short run, they may be able to charge prices above ADC and have economic profit, but in the long run, they will return to normal profit and their price will be equal to the ADC, albeit it will not be at the minimum of the ADC curve. Okay, our next structure is oligopoly. So here we have a small number of interdependent firms. Now this is very, very important. The firms are interdependent, so they are going to be looking at each other's actions. So here we're going to be involving potentially game theory. So just imagine if you were thinking about the manufacturers of commercial airplanes, right? So the big two would be Airbus and Boeing. So I would imagine that if Airbus did something, Boeing would be keeping a close eye at its competitor. So we've got an oligopoly here with high barriers to entry. The business may be very technologically intense or capital intense, so it's very, very difficult for new competitors to come in and try to eat our profits away. So those high barriers to entry probably already suggest that this structure will be able to maintain economic profit in the long run, even though perfect competition and monopolistic competition had low barriers to entry and were not able to maintain economic profit in the long run. And here we've got some pricing models. The first model is the kinked demand curve. So with the kinked demand curve, what you will find is that the demand curve has a different slope above and below the current price. What you will find is that the demand curve is very elastic above the current price and very inelastic below the current price. So here we're talking about price elasticity of demand. In other words, how sensitive are we? How sensitive is our quantity demanded to changes in prices? Well, elastic demand means that we're very, very sensitive. Inelastic demand means we are very insensitive. So up here we are elastic, and down here we are inelastic. Now, why is that happening, my friends? Well, first of all, Imagine we had these two competitors, Airbus and Boeing. Well, if one of them decided to raise its prices, what would the other one have to do? Think about what would the other one have to do in order to do the best possible move in this game. Well, the other competitor will simply keep his prices constant. And if one competitor raises prices, the other one keeps prices constant, their customers are going to come to the one that's kept the prices constant, right? So the one that raises prices will lose customers, and therefore will face a very, very elastic demand curve above the current price level. So, for example, increasing price level by 5% might result in them losing quantity demanded by more than 5%. Now, on the other hand, if one of the competitors lowers their prices, then what should the other player do? Well, the other player would also have to lower their prices. Effectively, that would be starting a price war. So if they both lowered their prices, the ultimate winner of that will be the end consumer, but none of the two players will actually gain any additional market share. So that's why we're going to say that the demand curve below the current price level is highly inelastic. So what does that mean in terms of the conclusion from the kinked demand curve model? According to the kinked demand curve model, a price rise will not be followed, resulting in a highly elastic demand curve, but a price drop will have to be followed, resulting in a highly inelastic demand curve and a price war. Okay, the next model is the Cournot model developed by a French mathematician. So the Cournot model looks at a duopoly. And in that duopoly, you have two identical firms, and they're going to be making simultaneous decisions. So they will not be able to consider the move of their opponent. And therefore, I like to use the analogy of a chess game, right? In chess, we've got white and black, and normally white will move before black. But let's say that under the Cournot assumption, they are both able to move at the same time. Okay, so obviously, if they're moving at the same time, if you play chess, you will know that that'll be absolute chaos. But I will have to make moves without knowing what my opponent will do. So it's definitely going to be a fun game, but I won't be able to really retaliate at all or be able to react to my opponent. So what Cournot did is he ran the model for, 20 moves for a certain number of moves, and then he discovered that after a certain number of periods, the two identical firms will equally share the market, which is a reasonable conclusion, right? We start with identical firms in a duopoly. They're moving at the same time. Why should one of them come ahead? So they equally shared the market. The final price under the Cournot model was actually higher than the price under perfect competition, and the quantity supplied was lower than under perfect competition. But then compared to the other extreme, which was monopoly, the price was lower than a monopoly, and it was higher. The quantity supplied was higher than under monopoly. Then you've got the Stackelberg model. So the Stackelberg model is kind of similar to the Cournot model with one key exception, which is the ability to retaliate. So in the Stackelberg model, one player has to move before the other player. So one player has the first mover advantage. So back to our chess analogy, white has to move before black, and with perfect play, white should have an advantage. So under the Stackelberg model, the person who moves first ends up capturing a larger portion of the market. And then we have Nash equilibrium, and often Nash equilibrium is explained via a concept known as the prisoner's dilemma, right? So in a prisoner's dilemma situation, there are two suspects that have been taken for interrogation by the police. They've been separated in different rooms, and they essentially don't know what the other person will say or not say, but each of them have two options essentially. They can confess to the crime or they can remain silent. Now, if they both remain silent, they walk free. If they both confess, let's say they both get 2 years in prison. But if one of them confesses and the other one doesn't, then the one that doesn't confess will get a very, very lengthy prison sentence, let's say 10 years, whereas the other one will have maybe 6 months. Okay, the numbers are not very important, but the key point is that what we are trying to show here is that if we don't have collusion, if these prisoners are not able to talk to each other, then their optimal solution is to both confess. By both confessing, their collective outcome is worse than if they both remain silent. Because remember, if they both remain silent, they would walk free. But if they both confessed, they would both get a 2-year sentence. And why do we talk about this prisoner's dilemma? We talk about it in the context of oligopolies because, of course, if you've got an oligopoly, and if the oligopoly is able to collude, right, if they were somehow able to come to an agreement about quantities or prices, right, think about some sort of cartel whereby the members are agreeing. If they're able to do that, then they're going to be able to capture economic profit, right? And if they were not able to collude, then they would behave more like perfect competition, and they're not going to be able to capture economic profit. So Nash equilibrium essentially is this idea that these players in a chess game will have to make moves that are ultimately optimal for themselves, and the equilibrium point is reached when no single player can make a move that further improves his own situation, right? So back to this idea of collusion. If collusion is not possible, or if it is not possible for the oligopolies to check whether the other members of the cartel are cheating or not, then they will all end up not honoring the collusion agreement and therefore expanding production, reducing prices up to a point where only normal profit is possible. Okay, the next structure is the monopoly. So here we've got the other extreme to perfect competition. This is where we have a single seller of maybe a unique product with very, very high barriers to entry. Here we are able to keep our economic profit forever or for a very long period of time because the high barriers to entry are preventing other players from coming and eating our profit away. So maybe think here the supplier of electricity or railways could be considered monopolies. Now, of course, this type of monopolies are heavily regulated, so perhaps the government may force them to lower their prices and in some cases subsidize them. But in terms of the picture, we can actually go back and use this picture. Okay, the difference with monopolistic competition is that this time the average total cost curve will be below the current price. So this time, let's say this is the price for a monopoly. And you can see that the price that we are charging is up here, but the average total cost is much lower. So this rectangular area is our economic profit under a monopoly. Remember that the picture would have been very, very similar for monopolistic competition, perhaps in the short run, but in the long run, more competitors would have come in and eaten that economic profit away, whereas under monopoly, this economic profit can persist in the short run as well as the long run because of our high barriers to entry. And finally, we have some concentration measures to go over. So these measures are measures of how concentrated or fragmented the market is. So the N-firm ratio simply takes the first few largest companies in the market and sums its market shares, whereas the Herfindahl-Hirschman index takes the sum of the squared market shares. So the Herfindahl-Hirschman has this added advantage of magnifying the larger companies, so it tends to be used by the antitrust division of the DOJ to perhaps challenge merger activity when it is considered to be anti-competitive. So let's have a look at this example here. So calculate the three-firm HHI if the three largest firms have market shares of 40, 30, and 25%. So first of all, if I was doing the M-firm ratio, I would just say 40 plus 30 is 70, plus 25 is 95. The HHI would be equal to, so we take 0.4 squared plus 0.3 squared plus 0.25 squared. We take the market share, square them, and this gives us 0.3125. So bear in mind that the HHI can range between 0 and 1, because if you have lots of little tiny companies with 0% market shares, the sum of 0 squares is close to 0. Whereas if you had a monopoly with a market share of 100% or 1 squared is 1. So the theoretical maximum of the HHI is in fact 1. So you don't need to know this, but once the HHI goes above 0.18, this is considered highly, highly concentrated and not competitive, and that is where the antitrust division of the DOJ will start taking significant interest in the merger. But that's all I had for you in this reading. Thank you very much for watching, and see you in the next reading. Goodbye.